this seminar. Hopefully we'll be able to sort out some of your questions and give you some ideas about a way to move forward in these uncertain times. Just to give you an overview of what we're going to cover today. There we go. So we're going to look over some of the legislation that's been proposed. We're going to talk about some things that are likely to happen or not as likely to happen. And then we'll go over some techniques that provide some flexibility so that you can do some planning for the law changes, but if the law doesn't change, you can change course. And then we'll also talk about some techniques that can still be used, whether or not the law changes. So let me just go to the next slide, and we'll talk a little bit about Bernie Sanders' bill. So this is a bill called the For the 99.5% Act. It's a bill that Bernie Sanders had put into Congress before in 2019, but the effective date for the bill's changes are January 1, 2022. And I see we already have a question in the chat about the effective date of the changes, so we'll talk about that as we go through this. And so that's the date of the effective date of the changes to the estate tax laws, but it was filed on March 25th, 2021. And there have been times when the filing date ended up becoming the effective date of changes. And the bill itself makes several dramatic changes to estate planning techniques and uses the date of enactment as the effective date. So if a bill passes in the fall, the changes relating to the different techniques we'll discuss later in this seminar will have been changed as the date of enactment, not 2022. So we really only have, if something passes Congress, we only have a few months to do some planning to deal with this act. The big change, reduce the estate tax exclusion to 3.5 million, which is the number it was about 12 years ago. And that number is not indexed. We've all gotten very used to numbers being indexed. The original exclusion was raised from 3.5 million to 5 million, but then it was indexed. And then that number was doubled, so then it became 10 million, but indexed, it became 11 point something million. And currently that number is 11.7 million. And that is indexed. So that's a big change. It not only drops the number by 70%, but it's not going to be indexed for inflation. Now, the bigger change, even than that, is that the gift tax exclusion is dropped to $1 million, also not indexed. And the current law has the estate and gift tax exclusions tied together. And so you can use them up during your life with gifts, or you can use them up at death through the estate tax exclusion. But they're combined and they're unified as this $11.7 million number. So one of the other changes here is to reduce the number significantly. So, and then to increase the estate tax rate from 40% to as high as 65%. And we'll talk a little more about that. Now, I mentioned earlier about the date of enactment. You'll see these changes here with the little asterisks. Those are the ones that are effective on the date of enactment, not January 1, 2022. So they'll be eliminating valuation discounts for non-business assets. Their tax grantor trusts as assets subject to estate and gift taxes. Change rules for grantor retained annuity trust, or GRATs, we call them. It would tax generation skipping dynasty trusts sooner than the current law. And then it would cap annual gifting to trusts. These are the crummy power type gifts to $30,000 per person per year. And that $30,000 is indexed. And then I'll make a final note on this slide, and that is that many of these provisions are vetted for cost to the government or the revenue that they would raise. And that's important because it's very easy to drop in bits and pieces of this bill if the Congress needs to raise a little revenue. So we'll talk just briefly about President Biden's proposals. These are from his campaign trail and from people in his administration now. There's not a specific proposal on the table. And the president's focus has been on raising income taxes on higher earners. So many of the proposals put forth by the administration have dealt with income taxes. But there has been discussion about reducing the estate tax exclusion to 5 million or 3.5 million. And either of those, the 5 million would be indexed, the 3.5 would not be indexed. And then to reduce the gift tax exclusion to $1 million, not indexed. Increase the estate tax rate from 40 to 45%, but no discussion about the 50, 55, and 65% brackets. And then there's been a lot of talk, and again, this is because it deals with capital gains taxes, ending the step up in basis on gains over $100,000. And right now, if you die, you have up to $11.7 million of possible step up in basis. So this would be a dramatic reduction from 11.7 million of potential capital gains wipeout to 100,000. Anything over 100,000 would be subject to tax. And then there's also been some discussion in the administration about taxing unrealized gains at death. So not only would there not be a step up, it would be a step up in basis, but that step up would be taxed as a capital gain. The death would be treated as if it were a sale. And then finally, some discussions about eliminating Section 1031 exchanges. Again, income tax related, because those are used to defer capital gains tax. Now, these proposals aren't vetted for cost and revenue. So unlike Bernie Sanders' bill, it'd be harder for these to be dropped in or dropped out of a bill when the Congress needed to raise some revenue. And I only mention that because the 10-year rule for IRAs was dropped in at the last minute in December of 2019 because it would raise revenue, and it would so some of the other provisions of the bill would be paid for by changing the IRA rules, and that's why it kind of caught us all off guard. So let's talk about some things that are more likely to happen. And I'll talk at the very end about why, even though Congress is divided and it seems like it would be very hard for things to happen, it is possible that some of these could happen. The three things we'll talk about are restricting grants, increasing the top gift and estate tax rate, and reducing the estate tax and gift tax exclusion. So we'll talk first about restrictions on grants. What is a grat? It's an irrevocable transfer of assets that are likely to appreciate in value, typically to a trust, a grat trust, retaining a benefit for the grantor for a term of years, and the remainder typically passing to children in trust. Typically children rather than grandchildren, because there are some GST, generation skipping tax issues when you try to stretch that out past the first generation. Basically what the grat does is reduce the total value of the gift, and so then you have more exclusion to use on other techniques. And it does that because the gift is the remainder, and the remainder you can't reach until the intervening life estate is the term of the grat passes. And so to make it work, the client needs to outlive the initial term. If you pick a 5-year grat, you die in year 4, the grat ends up back in your estate typically. What you lose is the cost of the accounting and legal fees, but the exclusion is also restored. So it's sort of like you win if you outlive the term. If you don't outlive the term, you're no worse off than you are now, except for the cost to set it up. It's good for assets that are hard to value because it's only appraised once at the beginning. That sets the amount of the annuity payment, and then the asset doesn't have to be revalued each year. So grats, just the basic grat part of the statute. So a known concept, not any surprises. People know how to use it. There's case law, regulations. Is a helpful concept. Now, just to give you an example, if you had a $750,000 asset and you have qualified for a 33% valuation discount, so your asset's treated as $500,000 asset. If you gift that to your children, it's a $500,000 gift, even with the discounts. But if you set up a grat and the grantor is 60 years old, you set up for a 10-year term, 5% payout, the gift that you're making is $265,000, $266,000. So a $750,000 asset, you're only using up gift tax exclusion about a third of that value. And then during that 10-year term, the grantor is going to receive $250,000 of income. So again, if it's an asset where you want to keep the income for a while, but not forever, this would work really well. Then the remainder inside the grat itself at year 10 is on this projection, which is only assuming 4% growth, even with a 5% payout. The remainder in the GRAT is over $752,000, and that's outside the estate of the grantor. So for an exclusion cost of $265,000 or $266,000, $753,000 of assets are outside the estate. And part of that is because there's an assumption in the growth. Basically, this GRAT is getting all future growth out of the estate, all future appreciation of the asset. You can also optimize to reduce the gift. So this may also be a technique that you use in the future when there is no exclusion, because you can reduce the gift down. So for example, if you had a 10.7% payout, the gift would be zero in this case. And at the end of the term, about $217,000 would have gone out to the children. So for zero exclusion use, you got $217,000 of assets out of the estate. Now, it's not as good as the prior example because you also ended up with $500,000 of payments that are now in your estate that you're going to have to figure out how to get out of your estate if you want to. To get out of your estate, if you want to. I'm sorry, I just had a brain freeze. If your goal here is to reduce your estate tax, so the proposed changes are to require a minimum 10-year GRAT, and then to require a minimum remainder of at least $500,000 or 25%, whichever is greater. What this bill is really trying to get at, because if you notice the last example was a 10-year GRAT, and it produced a really good result for the client. $750,000 asset out of the estate, got a gift of only about $250,000. So even just the basic GRAT can be helpful. But what the bill was trying to get at is that there were other techniques that were being used called short-term GRATs, where you might do 2-year terms, and laddered GRATs. And the idea was you get these GRATs zeroed out, so you're paying almost no gift tax or using up no exclusion. And then you were laddering the GRATs. So you would set up 5 GRATs, 2-year term, 4-year term, 6-year term, 8-year term, 10-year term. And then the idea being, well, if a real good chance you'll live 2 years, so then that'll get that GRAT out of your estate. Still a good chance you'll live 4 years, 6 years, but you're spreading out the risk over 5 different GRATs and these ladder GRATs. And so it's reducing the risk that the asset will come back into your estate. And just as a note, the Biden administration has also indicated, some of the officials in the Biden administration have indicated they would favor curbing the use of GRATs. I think what's going to happen if any of these kind of changes go through, I mean, one is designed to reduce the ability of a technique that's been very, very helpful and very efficient. But it also is going to start to turn GRATs into a one-size-fits-all, because some donors or grantors are not going to be able to do a 10-year term because of their age or their health, and so the risk of doing it is eliminated. So we'll see how that goes. The next change that's more likely to happen is an increase in the gift and estate tax rate. And just so you know, it was 45% before the last set of laws that went through. So it's really, it's not something new necessarily. In fact, the rates have been as high as 90% in the past, 40, 50 years ago, but still they have been higher. The estate tax and gift tax rates are on a graduated scale that start at 18%, and then they go up to the top rate. At least this is what's proposed now, instead of a flat 40%. And that increase would kick in at about $1 million of assets. So basically, once someone had used up their gift tax exemption, if they made a taxable gift, they'd be paying the 45% tax on that gift. And then less likely as far as the increase in the estate and gift tax rates, but part of the Sanders bill, so I want to talk about it, is a surcharge rate of 50%. So we're adding more brackets to the top of the scale above the 45%. So a 50% bracket for estates over $10 million, and a 55% bracket if you're over $50 million. And then finally, if your estate's over $1 billion, the top bracket would be 65%. And we have had surcharges in the past. It's probably been about 15 years, but we have had them in the past. And as I said, the rate for estate tax has been as high as 90%. So there's no reason to think this is just completely out of the ordinary. Part of what's driving this bill from Bernie Sanders, you may have seen his article in The Guardian, where he basically points out that the top 1%, so about 3 million of Americans, own more than the bottom 92% of Americans, which is about 300 million people. And so he's determined to, as a policy matter with the state tax, to eliminate the ability to accumulate large amounts of wealth by having these higher brackets. And then the third thing that's not as likely, the more likely to happen, is to reduce the $11.7 million gift estate tax exclusion. As I mentioned before, the Sanders bill reduces it to $3.5 million. And the Biden administration has variously suggested reducing it to 3.5 or $5 million. And just as a reminder, under existing law, with no action by Congress, the gift and estate tax exclusion is scheduled to drop to $5 million in 2026. So something's going to happen, whether it's now or then. There's going to be a change in the law. If this law doesn't pass, it still makes sense to be planning for the change where the exclusion is going to be dropped in half in just a few years. So let's talk about a few things that are not as likely to happen. The bill has some limits on valuation discounts. It changes the grantor trust rules. It replaces step-up basis for estate tax purposes with carryover basis. This is actually something proposed by the Biden administration. And it imposes generation skipping tax within 50 years. So just hang on to that 50 years because that's a dramatic reduction if it were to go through. The limit on valuation discounts would not be on business assets. So if you were trying to value a business, these changes won't apply. They apply to non-business assets. And basically that's any asset that's not used in an active trade or business. So any kind of investment property, and then techniques, ownership of other entities, things like that, trusts, that's where these limitations on valuation discounts would play in. And they would affect lack of marketability, lack of control, minority interest, and similar discounts. And they would apply both to when you make gifts and at death. And so it's the concept is to increase the base on which is subject to tax. And then there's also in this law or this bill that's proposed sort of a look-through rule. And so when entities own other entities, even as low a percentage as 10% of another entity, the assets of that entity are deemed owned by the parent. And then from there you go back to family. And here we're talking about ancestors and descendants. So parents, grandparents, children, grandchildren, and then a spouse, and then a spouse of descendants. So we're not talking about brothers and sisters. It's not as broad a definition of family, but within that group, that lineal up and down group of ancestors and descendants, all those people get aggregated together. And so will have the effect of eliminating lack of control, minority interest, because basically the bill is assuming that all these people together have the control, together have a majority interest. And so some of those discounts will be wiped out by that change. Pretty dramatic change. The thought is that it probably won't happen as likely. So then the other change is the change of grantor trust rules. And this again is a very dramatic change. And in an area where we do a lot of planning with grantor trusts, and when I say grantor trust for this seminar, what I'm saying is a trust that for income tax purposes is deemed to be the grantor or the grantors. So the grantor is taxed on the income from the trust. But for estate tax purposes, the trust is not part of the grantor's estate. So that allows the grantor to sort of retain income, not have to worry about income taxes, not worry about the top brackets trusts pay on income taxes, but at the same time get the asset out of the estate for estate tax purposes. So you can kind of play it both ways. The bill basically says, look, you can't play it both ways. If you've got a grantor trust where you're deemed to be the income owner, then any transactions that trust does, it's as if the grantor did it. So I put a list here of some of those things: distributions to others from a grantor trust. So during the grantor's life, is treated as a gift by the grantor. It has to be reported accordingly. If the trust loses its grantor trust status, or oftentimes we'll set up a trust so that we can toggle it off. So we want income tax to the grantor during the grantor's lifetime, but then we decide at 10 years out, we don't want that anymore. We turn it off by changing by how the trust is drafted. We can turn it off. If you do that, then it's treated as if the grantor made a gift of the assets in the trust to the beneficiaries of the trust. So again, suddenly it's a gift. Same way is assets that are in the grantor trust at the grantor's death are treated as part of his estate. And then it does make clear there's no step-up basis for transfers to grantor trust. That's unless the trust is included in the estate. That's typically the way most estate planners see it, but there are some trust concepts that do try to get a step up in basis. So we won't go into that right now, but the law is making it clear that's not going to be available. And then the gift or estate tax that results from this will be imposed as a liability on the trust. And that's probably okay. A lot of times we say that in our estate planning documents anyway. But again, it may be different than when the trust was first set up. It may be different than what was intended. So let me just see here. There's a question. Yeah, and I will talk a little bit about there's a question about what happens to gifts that are already made. And so the last thing not as likely to happen, actually two more things, is to replace the step-up basis rule for estate tax purposes with the carryover basis. There's several different approaches to this, and again, these are coming from the administration where they're focusing on capital gains tax. But donees of gifts typically have a carryover basis. So if somebody gives you an asset, your basis is the same as the person who gave it to you. And then if you sell the asset, then you pay capital gains at that time. So that's the same rule. What's being proposed is that if you inherit an asset, you also get a carryover basis. And so if you later sell it, then you pay all the capital gains tax at that time. So that's a little different than what I had said earlier about taxing the unrealized appreciation at death. This concept is a little less onerous. It just says, look, you're going to get the same basis as the person who died, and at your later death, you'll hand it on to your heirs with the same basis you received. Or if you sell it while you're alive, then you'll pay the capital gains tax. Most people don't think this will happen because it's very difficult to administer this. Mostly creates kind of unfair results, because if you can't prove your basis, then you end up with zero, and then you end up paying capital gains on assets that includes basis. There were some changes in the estate tax return provisions in the last 10 years or so that now require executors to report basis, the fair market value basis of assets that are distributed to beneficiaries, so that beneficiaries know their basis. So it's possible that that can be accomplished through that style. But again, executors may not know the basis of decedent's assets. And then I mentioned already the Canadian tax for estate is, instead of estate tax, they tax unrealized appreciation at death. So it's always a possibility. And then the last part of things that not as likely to happen, but would be pretty dramatic, is imposing generation skipping tax within 50 years. And the Sanders bill is fairly onerous. It's basically trying to stop dynasty trusts. So if there's a trust that already is in existence today, and we think we're going to get the Florida 360-year perpetuities period, this bill doesn't provide any grandfathering for that trust. So even though we set it up thinking we're going to go to the grandchildren, great-grandchildren, and maybe as long as 360 years, this says those trusts will be treated no longer grandfathered after 50 years. And so distributions at 50 years will be subject to generation skipping tax. And the idea here that the reason you want to set up a dynasty trust is so you can avoid paying estate tax on each successive generation. The generation skipping tax tries to to catch that and tax it anyway. So what this bill does is say after 50 years, the trust is subject to generation skipping tax. If you create a trust after the date of enactment and you set up that the term is only for 50 years, then you'll get your 50 years, just like the grandfathered trust in item 1. However, if you set up a GST trust after the date of enactment and it's not a term no longer than 50 years, it's immediately subject to GST tax. So it's kind of a penalty for trying to do a dynasty trust after the date of enactment. So we'll talk, let me just check the notes here. Yeah, and there's a question, will the slides be available after the presentation? And they will. So let's talk about some techniques that provide flexibility. And this is not an exclusive list, and there is overlap between these. I realized as I was trying to organize it, it's very hard to do a list of things that provide flexibility, but I just want to talk about some ways to be thinking about things if you want to do some planning now, but you're kind of reluctant because we're basically hearing two things. One is, Congress is poised to pass something and they'll do it through reconciliation and they want to raise some revenue to pay for programs. And so something's going to happen. And then on the other hand, we're told there's no way Congress is ever going to pass anything. And these are such dramatic changes that it will create upheaval. And so what are we supposed to do? Well, for some clients, they want to do something and try to be proactive. And so here are some concepts that might help give you the ability to sort of look back and make a change or sort of switch one way or the other when we know more of what's going on in the new year. And of course, we all know you can never really assume that something's going to happen on the timeline we think. People say, well, if Congress is going to pass this kind of law, they're going to pass it probably after October in the new fiscal year and before the end of the year so that it can have the January 1, 2022 effective date and not work its way into the re-election cycle, which will be in 2022. But there have been many times when Congress has dragged this out, and they finally do pass something, but it's in 2022, right before elections, or it's even in 2023, right after the elections. And then who knows, because this stuff has been out there, whether they'll take effective dates after the date of enactment or they'll back it up to include part of 2022. And so for that reason, we need techniques that give us some kind of flexibility to make a change or make a switch, or that it doesn't matter what happens with the law. So one is formula gifts. And this basically, you make a gift now before enactment of a defined dollar amount or fractional share of an asset. And then you're using values as finally determined for gift tax purposes, which are also tied to the amount of the gift tax exclusion on the date of the gift. So it does require some special drafting, and it's not settled law. It's similar, if you've heard of a Wandry clause, it's similar to that. It's also analogous, more analogous to a marital funding clause, where you say, for example, I put into my credit shelter trust the amount of my exclusion, and anything that exceeds that, I put into the marital trust. Or I put everything in the marital trust, but my wife can disclaim assets into the credit shelter trust. I mean, those kind of funding clauses we use all the time. So basically what we're saying is we are going to, make a gift. We think we're making a $10 million gift, but if the law somehow changes later and the gift tax exclusion is only $3.5 million, then we've made a $3.5 million gift. And hopefully before the gift tax return is due, we'll know that, and we'll be able to report it in October of 2022. So that's basically how the formula clause works. The other thing to think about is loans to family members or trusts for them. If you do the trust, you control it for longer, and also you can keep it out of the children's estates for credit or for estate tax purposes. We can also keep their creditors from getting their hands on it. The beauty of loans right now is that interest rates are historically low. So the 2021 May rate for a 9-year promissory note is just over 1%. So it's not a high interest cost to do that. And then you can also combine these kinds of loans with other things like an installment sale, where you're selling an asset in exchange for a promissory note. And then that note could even have a self-canceling feature where at your death, the note reduces to zero. So if the estate tax exclusion is lowered retroactively, then you do nothing, and you just keep on with your loan. If the law doesn't change, so you still have this huge exemption, then in the future you can make a decision to forgive some of the principal on the note in the future and use up this exclusion that you didn't think you still had. Just will note that that can't be a prearranged plan to forgive the note. It just has to be an independent decision you might make in the future to do that. So another thing to do, or you could do, and this takes a special drafting, is a trust with built-in disclaimer planning. Now we're all probably familiar with all assets to surviving spouse. Surviving spouse has a right to disclaim, and basically the surviving spouse will make a decision at the first death if it makes sense to disclaim into a credit shelter trust, or to just keep it all, and then at the surviving spouse's death use the surviving spouse's exclusion and the surviving spouse's DSUA amount, which is the portability of the first spouse to die's exemption over to the surviving spouse. There may be some reasons nowadays why you want to use the exemption sooner than later. I'll also talk about that some more as we get further along. The difference here in this type of trust is that the disclaimed assets revert to the grantor, not onto the grantor's descendants. So our typical disclaimer trust, spouse has this disclaimer, and if spouse disclaims, then the assets go to the grantor's children or other descendants. Here, it would revert back to the grantor. And so if the estate tax exclusion is lowered, then you report the gift and you use up your previous larger gift tax exclusion. If the law doesn't change, so you still have the huge exemption, the beneficiary could, and hopefully would, disclaim the gift in the trust, and then the assets revert back to the grantor. So the grantor is back where the grantor started. You basically have 9 months from the date of gift to make the decision to disclaim. So if you make the gift in December, then you have until August to make the decision to disclaim. And then the estate tax return on extension, the gift tax return on extension would be due in October of that year. So another concept is Q-tip election trust planning. Again, you're making a large gift to a trust for a spouse. The trust has terms that permit a Q-tip election. Because this trust doesn't qualify for the basic marital deduction because the spouse doesn't have ownership or control over the trust. But the trust does have to provide all income is paid to the spouse. There's no other beneficiary during the spouse's lifetime. Principal can be distributed typically for health, education, maintenance, and support. And then the spouse or any other person can have powers over that trust. So it's a trust for the benefit of the spouse. If the gift tax exclusion is lowered, then you elect Q-tip because you have to elect it affirmatively, and as a result, there'll be no taxable gift due to the marital deduction. So it's just a pass. The asset will eventually be taxed when the surviving spouse dies. So if the law doesn't change, so you still have a higher exclusion, then don't elect the Q-tip treatment. So you don't get a marital deduction, and now you've made a taxable gift and you've used up your exclusion. And then this decision on the Q-tip can be made as late as October 15th of the year following, because we don't have a disclaimer here, so we're not tied to 9 months from the date of gift. We just make the Q-tip election by the due date of the return, and that can include as extended. So we can make that decision. So he has a chance to do some planning there. And related to that is the Spousal Lifetime Access Trust. Sometimes called a SLAT. Basically here, the grantor is making an irrevocable gift to a trust for the benefit of the spouse. The access is indirect. The access for the grantor is indirect. It's based on the fact that spouses are living in the same household. So obviously, if they want to buy a bigger house, the spouse who's the beneficiary of the trust could buy the bigger house. Or if they need more income, the spouse who's a beneficiary of the SLAT can get the income, and then that benefits both spouses. So this is sort of a similar to the Q-tip planning trust. It involves the spouse, and it's sort of a middle ground. You're not giving it away to children or to trust for children immediately or to grandchildren. So you still have some access, some limited form of access to the asset during your lifetime. There is a risk, though. There's a later divorce, or if the spouse who's the beneficiary predeceases the grantor, likely then you've lost the benefit of that. Sometimes to hedge that, the spouses will each do a SLAT for the other. My recommendation is that you do one SLAT and then you do one something else, just to avoid an IRS doctrine called the reciprocal trust doctrine, which would try to basically just undo the two trusts and eliminate the benefit of the two trusts. So if the law changes and if needed, then you elect Q-tip treatment. And so there's no taxable gift due to the marital deduction. And the assets out of the estate without using gift tax exclusion. And I say if needed, because sometimes these trusts can be set up so that there isn't a gift. And so you don't have to worry about using marital deduction to wipe out the gift, because the way it's set up, the gift is very small. If the law doesn't change, just like with the Q-tip trust, don't elect Q-tip treatment. So there's no marital deduction, and then your transfer has used up your larger gift exclusion that was under the existing law. And then just like with the Q-tip election, you've got until basically October 15th of the year following to decide what you're going to do. Another concept is the intentionally defective grantor trust. This is not actually a gift event, except for the initial funding of the trust that's actually buying the asset. Basically, an intentionally defective grantor trust it's defective in the sense that it's purposefully a grantor trust so that the grantor can sell an asset to the trust. And because it's a grantor trust, it's as if the grantor sold it to himself or herself. So there's no tax event that happens. Because it's a sale, you're not worrying about the gift tax rules, gift tax exclusion. In theory, you're not even using exclusion. And so you can sell this high asset value to the trust for a down payment from the trust and a promissory note. And I mentioned it doesn't use gift tax exclusion, but you may have to use some exclusion to fund some assets into the trust, because you need to have enough funds in the trust that it can, one, make its down payment, which needs to be a reasonable down payment, and then be able to show that it has the financial wherewithal, either from the asset it just purchased or from additional cash in the trust, to actually make the payments as they come due. So if the law changes, well, you don't care. The asset's out of the estate and you didn't use the state tax exclusion anyway. And so this is a trust tech that you can also use before the law changes or after the law changes, or if it doesn't change. If it doesn't change, then you can decide later, again, without any pre-arranged plan, to make a gift of the note. And then as you do that, you would be using up the exemption that ends up still existing. Another technique is a charitable remainder trust. I think I'm just checking here. It says CLT, but it should be CRT. Basically, you're transferring assets to trust, you're retaining income from the assets for a term or lifetime, and the remainder passes to charity. And because it's passing to charity, there's no estate tax exclusion needed at the later death. And so it's a helpful technique. That's why we're putting it here. It gives you flexibility. If you want to benefit charity, you'd like to retain the benefit of the asset for your lifetime, then the charitable remainder trust allows you to do that. And then at your later death, the asset goes to charity, you get a shareholder deduction, and it doesn't use up your exclusion. And so if you set it up as an annuity trust, a CRAT, there's no ongoing annual value appraisals. And so that's a reason sometimes to do a CRAT when you don't want to keep revaluing the asset. If the assets are easy to value, you might do a CRUT, which is a unitrust. And the reason you do that is because the unitrust is a percentage of the funds, so it provides a hedge against inflation. As the assets grow, the amount that's paid to the beneficiary increases. And you can even zero out the gift so that you're not even using the exemption. So like with the IDGIT, the CRT allows you to not be concerned about changes in law because you can just avoid gift altogether. Then finally, a technique that will provide some flexibility is to plan to do a 1031 exchange. Again, not really an estate and gift tax concept, but because if there are changes to the estate and gift tax laws, there are also likely to be changes to the income tax and capital gains laws. And so the 1031 exchange allows you to defer capital gains tax. Now, you wouldn't do a 1031 if you have other losses you want to offset against your capital gains, or if you have expiring NOL carry forwards, and if you want to increase the basis for purposes of taking appreciation. So let me talk a little bit about, well, just quickly, for a 1031 exchange, you've got to exchange property that's held for trade or business or for investment. You have to trade it with replacement property. It doesn't have to be identical. So an office building can be replaced with raw land, vice versa. You do have to identify that property within 45 days, and you do have to close that sale within 180 days. So let me talk about some techniques that can still be used that aren't really as affected by changes in law. One of them, just switch forward here. One of them is a charitable lead annuity trust. And it basically, if you have assets that are likely to appreciate in value, you transfer them to the trust. And because you're giving a lifetime benefit or for a term of years to charity, and then remainder to family and trust typically, your gift is lower because there's this intervening charitable term that makes the remainder interest worth less. And so for less estate tax exclusion, you're getting the asset out of your estate. The other thing is a CLAT also gives you an upfront income tax deduction, which sometimes can be useful. So if the law changes, the assets out of the estate, the client's estate, they get an income tax deduction, and that's probably helpful since income tax rates are likely to go higher. But if the law doesn't change, well, the assets are still out of the estate. With a, you know, and they're out of the estate, and the benefits that were the benefits to the children, if they receive it outright, is they'll use their exclusions and generation skipping tax exemptions, or depending on how the trust is worded, they'll use it through the trust. The asset is appraised only at the beginning, again, because it's an annuity, and so if it's a hard to value asset, it can be very helpful. So just as an example, $750,000 asset, 33% valuation discount, I'm using the same assumptions. You set up a CLAP for 10 years for charity, remainder to children. Your immediate charitable deduction is $351,000 on a $750,000 asset. And then the remainder taxable gift that you are making, the taxable gift is $398,000. And so you're using an exclusion for $398,000, but you are getting a $750,000 asset out of the estate. And then this last number shows the cost of making a gift to charity in this example, which again assumes 4% growth in the asset. The $660,000 is outside the estate. This is what's left in the trust at the end of the charitable term. And that is for a gift tax cost of $398,000. So there can be some benefit there, particularly if you're charitably inclined. Another concept is qualified personal residence trust, where you irrevocably transfer your personal residence, primary home, or vacation home to a trust. You're retaining a benefit for a term of years, and typically the remainder goes to children. CUPERTs, no one's talking about changing the CUPERT rules right now. And again, just like with the CLAT, because you're retaining a life interest before it goes to your children, that reduces the total value of the gift. And that means you have more exclusion to use for other techniques. You do have to outlive the term, just like a GRAT. And if you don't, you've lost your cost to set it up, but you still keep your estate tax exclusion. The asset's appraised only at the beginning. It doesn't have to be revalued each year, and you can even buy and sell houses in and out of the QPERT. You do have to pay rent at the end of the term if you want to stay in the house, but again, that's like a non-taxable gift. It's a gift. It's a gift without it being subject to gift tax. So that can be very useful. Another thing to consider, again, because part of the focus on raising income tax rates is to convert convert IRAs now to Roth IRAs. And then when distributions are later made, they're not subject to income tax. And so the theory is the conversion now at lower rates may save some income tax versus the higher rates that will come in the future. Then when beneficiaries inherit the Roth IRA, they are subject to that new 10-year rule. They have to take it all out in 10 years, but they don't owe income tax because it's not like a regular IRA. So basically what the client's doing is paying discounted income tax now for clients' beneficiaries and also reducing the size of the estate. And then last is annual lifetime gifts. And these basically what you're trying to do is use things that aren't subject to gift tax, and so they don't result in using your exclusion. These can be outright or to a trust, and the effect is you're trying to get assets you think will go up in value out of your hands into the hands of the recipient. And because it's less than $15,000 per person, that's the current number, that's an index number, there's no gift tax return required. But don't forget, you can also pay unlimited amounts directly to a healthcare provider for a beneficiary or directly to an educational institution for tuition. And so there's more than just the $15,000 per person per year that you can do. And I didn't mention it earlier, but one of the changes under the Sanders bill is to say you can still make $15,000 per person gifts outright to beneficiaries, but whenever you make them into trust, for example, to a crummy trust or things like that, you're capped at $30,000 total per year. So if you have a crummy trust that has two beneficiaries and you're putting a $30,000 premium into that trust, you're paying $30,000 gift into that trust each year to cover insurance premium, you'd be maxed out. If that trust had a $45,000 premium and three beneficiaries, for example, you would only have $30,000 allowed, and that extra $15,000 you pay into the trust would be a taxable gift that year. So there were some changes to how that works. So I'm going to look at some questions here just to make sure there weren't any additional ones. I promised I would talk about if they drop the estate tax exclusion, and the answer to that is it's a use it or lose it situation. So the exemption right now is $11.7 million. Just under current law in 2026, that number will drop to a little over 6 million. Different estimates, but between 6 and 6.25 million, somewhere in there. There's just over $6 million in 2026, even if there are no other changes. And so often people say, well, I have a $20 million estate, but I just want to make a $2 million gift. And they can do that. But the problem is when they, it's a use it or lose it. It's the way it's termed. And so basically to get the advantage of that extra amount before it drops, you have to use up that extra amount before the law changes. And so, unfortunately, unless someone's willing to make very large gifts, it's going to be very hard to capture that extra amount, and they may be stuck with the lower amount. But that's definitely something to consider. So sort of in conclusion, and then if you have questions, please write them in the chat. I would say don't be complacent. Some kind of changes are coming. They're either going to come this year or next year before the 2022 elections. But for sure, they'll come January 1, 2026. So we have anywhere from 3.5, we have from 6 months to 3.5 years to do some planning. And it may seem like Congress is divided, but deficit hawks want to raise revenue to cover government spending. And Democrats want to pay for programs. So you've got a strange set of bedfellows here. It's a recipe for changes in the rules. And as I mentioned before, because Bernie Sanders' bill has already been scored for costs and revenue, it would be very easy for them to say, okay, we'll drop in the GRAP provisions, or we'll drop in the GST provisions, or maybe we'll change the GST to 100 years instead of, there are things they could drop in that could be surprises along the way. And so you just have to be aware of that. And as I mentioned earlier, the date of enactment means that some of these techniques might not be available later this year. So it behooves people to look at their estate plans in the next few months and take any action that they think they want to take then. We talk about 2026, short of Congress acting and raising the exemption or extending the exemption, the change to drop the exclusion by half is automatic. So Congress doesn't have to act. The president doesn't have to sign anything. It's just magically happens on January 1, 2026, the exclusion's cut in half. And so if you have clients, particularly, anyone who, well, it's hard to say what the rule of thumb is, but certainly if you have more than 20 million of assets, it makes sense to start looking at trying to use up that exclusion that would otherwise be lost. Otherwise, you will end up having to do different techniques to try to get the estate passing estate tax free with less exclusion to work with. And a lot of these techniques we discussed today, those exclusions help you reduce the amount of, those concepts reduce the amount of exclusion you use. And because of that, you're able to do more techniques or to get more assets out of the estate. So thank you all for coming today.